Something huge is happening quietly behind the scenes in the world of venture capital. The entire engine that funds our most innovative startups is fundamentally changing. And today, we're going to pull back the curtain and break down exactly what's going on. So, let's just start with one number: 1,122. In the first quarter of 2025, that's how many venture deals got done. Now, to put that in perspective, that is the lowest number we have seen since 2018, a massive drop. So, what on earth is happening? You look at a number like that, and it's easy to ask, is the whole system just broken? But here's the twist. This isn't the story about retreat. This drop isn't an ending. It's the catalyst for a radical reinvention of the entire industry. Okay, so to really get what's changing, we first have to understand how things used to be. For decades, the investment world had two very different players on the field: venture capital and private equity. All right, so this chart basically lays out the old world order. Over here on the left, that was venture capital's playground. Small, super early stage bets on moonshots. We're talking long, 8 to 10-year gambles. Then, way over on the right, you've got private equity. They show up much later, buying bigger, established companies, looking for predictable returns over a much shorter 3 to 5 year window. So think about it this way. VCs were built to fund that crazy, uncertain journey from a garage idea all the way to an IPO. Private equity, they kind of took over from there. The lines were drawn in the sand, until now.
You see, the recent market downturn didn't just slow things down. It was the shock to the system that forced the biggest names in VC to completely change their entire model. It was the starting gun for a massive strategic pivot.
And this right here is the legal key that unlocked the whole thing. By becoming what's called a registered investment advisor, or an RIA, these VC firms basically gave themselves a superpower. They're no longer legally boxed in to just funding new startups. They can now go big into public stocks, crypto, or even just buy and sell stakes in other existing companies.
And listen, this isn't some small fringe movement we're talking about. These are the titans of the industry. I mean, Andreessen Horowitz, Sequoia, Lightspeed, General Catalyst, the absolute biggest names out there. They've all made this switch. This isn't a small tremor, it's an industry-wide earthquake. So what do you do with all this newfound freedom? Well, you start to write a completely new playbook. One that looks a whole lot less like traditional VC and a whole lot more like private equity. Let's look at the new plays they're running. First, they're acting like traders, buying and selling stakes in companies on secondary markets. Second, and this is huge, they're not just investing anymore. They are acquiring and operating entire businesses. They're even building their own wealth management divisions and, get this, thinking about going public themselves. That's literally copying the exact playbook of PE giants like Blackstone.
And this isn't some small side project. Take Thrive Capital. They launched a $1 billion fund just to buy and operate companies that have been transformed by AI. That is a classic private equity move focused on control and long-term operations.
And if you need any more proof of this identity shift, look no further than General Catalyst. One of the most respected VCs in the world no longer calls itself a venture capital firm. Their new branding? A global investment and transformation company. I mean, that says it all, right? The message couldn't be clearer. So to really see what this all means, let's go back to that investment map from earlier. Remember the separate territories? High risk, early stage ideas on the left, and safer, late stage buyouts on the right. What these pioneering VCs are doing is actually really simple, but it's profound. They're sliding all the way across the spectrum. They're moving away from the far left and planting their flag firmly on the right side of the chart. So, what does this all mean for the future of Silicon Valley? For the next generation of founders with a crazy idea? Well, this shift is creating a brand new landscape. Now let's be super clear here. Venture capital isn't disappearing, not at all. It's maturing. You could say it's growing up. It's becoming more sophisticated, and it's focusing its massive piles of cash where it thinks it can find more predictable value. And the why behind all this is simple. They're getting tired of waiting a decade for a high-risk moonshot to maybe pay off. They're now chasing what private equity has always had, more predictable returns in a much shorter time frame. It's a very deliberate move away from the high-risk model that built Silicon Valley.
And this right here is the single most important takeaway from this entire shift. As the giants move downstream to hunt for safer bets, they are leaving a massive opportunity gap behind them. A vacuum is being created right at the very beginning of the startup journey, and it's just waiting to be filled by a new generation of investors, ones who are willing to take on that pure, early-stage risk.
So you see, this isn't just a small change. It's a complete restructuring of the innovation economy. The giants are becoming more like banks, leaving the wild frontier wide open for new pioneers. And the big question that leaves us with is, how do you see this whole evolution playing out?